Hey, everyone! The stock market is inching toward record-breaking levels, and the big question that's on everyone's mind right now is now the right time to invest in stocks? To really get a grip on this, there are four major factors you need to keep an eye on. 1. Inflation. 2. Tariffs. 3. The economy. 4. Historical patterns. Let's break each of these down so you can make smarter, more confident investment decisions. Part 1. Inflation. Let's start with inflation, the one that's been all over the headlines. We just received the latest inflation data, and it came in lower than what many experts were predicting. That's a good sign, sort of. A lower inflation rate doesn't mean prices are dropping, it just means they're rising more slowly than before. Now, let's dig into where inflation is still high and where it's actually turned negative. Biggest areas of rising prices. Auto insurance is leading the pack. Household energy costs, housing expenses, eating out at restaurants, where prices are cooling or even falling. Gasoline prices, airfares, electronics. But here's the catch. Even if the rate of inflation is cooling down, it's stacking on top of the previous year's inflation. So prices are still significantly higher than they were a few years ago, just rising at a slower pace now. And when we look at wages, the average salary in the U.S. has increased about 4-5, while inflation has risen by 15-20 over the past few years. That means real purchasing power has shrunk. Yes, the Federal Reserve wants to bring inflation down to the 2% target. We're not quite there yet, but even if we get there, it doesn't undo the price hikes we've already lived through. Part 2. Tariffs. Next up, tariffs. The U.S. and China have been going back and forth trying to finalize a new trade agreement. President Trump recently mentioned that the deal is done, but it's waiting for final approvals. Meanwhile, the Treasury Secretary hinted that if both sides act in good faith, we could see a pause or delay in new tariffs. Why does this matter? Because tariff announcements have a history of rattling the markets. Every time there's a surprise tariff or even a threat of one, stocks can swing wildly. The next big update on tariffs is expected on July 15th, and investors are watching closely. If talks fall through and more tariffs are added, it could put pressure on global trade and slow down business growth, which could hit the stock market hard. Part 3. The economy. Now, let's talk about the overall economy. It's sending some mixed signals right now. The official unemployment rate is still low, which sounds great on paper, but if you ask around, a lot of people are saying the job market doesn't feel strong. Many workers are underemployed. They're overqualified for their current jobs or juggling multiple part-time gigs just to get by. That can make the employment data look stronger than the reality. Also worth noting, consumer debt is climbing. Credit card balances are hitting record highs month after month. Some see that as a good sign because it shows people are spending. But on the flip side, it also means people are relying more on debt to get through the month. And remember, spending is the engine of our economy. Whether that spending comes from cash or credit doesn't matter much to the system. In fact, the system prefers debt spending. Why? Because spending with credit increases total dollars moving through the economy, and banks profit from the interest. That's why the economy can look strong even while the average household is stretched thin. But long term, this kind of debt-fueled growth isn't sustainable forever. Eventually, there has to be a breaking point. Part 4. History and long-term perspective. And now, the most important piece of all, history. Let's say you invested at the top of the market right before a crash, like before the 2020 pandemic or the 2008 financial crisis. If you didn't sell in panic and held solid investments like broad index funds, you'd likely be up significantly today. Same goes for the dot-com bubble in the early 2000s. If you bought and held high-quality assets, you came out ahead eventually. So what's the lesson here? You can't time the market perfectly. Nobody can. That's why the smartest strategy for most people is what Warren Buffett and many pros advocate. Time in the market beats timing the market. It's not about catching the lowest low or selling at the highest high. It's about staying invested for the long term. That's why I always say, IBB always be buying. Of course, that doesn't mean throwing money at random stocks. You need a strategy. I break it down into two main approaches. Passive investing. This is your set it and forget it approach. You consistently invest in broad market ETFs like the S&P 500 every week, every month, regardless of whether markets are up or down. You're not chasing trends. You're just building wealth over time. You might even choose to increase your contributions when the market dips, like buying good stocks on sale. Active investing. This is for those who want to pay more attention to shifts in the economy. For example, if new government policies favor clean energy or aerospace, you may choose to invest in those industries early. You're not trading daily, you're spotting trends early and positioning yourself accordingly. Closing thoughts. Look, we don't know what the market will do tomorrow. There could be more tariffs. Inflation might stay sticky. The economy could hit a rough patch. But what we do know is this: if you're investing for the long term, these short-term headlines should not scare you. Volatility is normal. Crashes are part of the journey. The key is to think like an investor, not a gambler. Understand how the economy works. Build a strategy that fits your goals. Stay consistent and never stop learning. If you want to stay informed with quick, smart, and fun breakdowns of the economy, stocks, and crypto, be sure to check out my free newsletter. It's called Market Pulse, and you'll get a free investing mini course when you sign up. Thanks for watching. Don't forget to like, comment, and subscribe, and let me know in the comments. Are you buying stocks right now? Or waiting for a dip?